Welcome back to our intermediate financial accounting class. Over the last few segments, we've been focused on retained earnings and about the special decisions, errors, entries that can change the reported retained earnings number. We've talked about changes in estimate, changes in principal, changes in entity, at least the part that we have time for. And then we started talking about changes caused by fixing mistakes or errors. We've talked about counterbalancing versus counterbalancing, and we've done an example of a counterbalancing error. What happens if the books are closed? What happens if the books are still open when we find the mistake? Now it's time to take a look at what happens with a non-counterbalancing error. And that leads us right back to our Daglin Incorporated example. You remember in the last segment, they found a small error with an interest expense that hadn't been recorded in year 2. And if the books were closed for year 3 when they found the mistake, we decided it was counterbalancing and we didn't have to worry about it. Now Daglin's auditors are back and they have found another mistake. In this case, they sold a machine on January 1 of year 2 for $9,000. The machine had originally cost us $25,000. Of that, $15,000 had already been depreciated away for GAAP. It was fully depreciated under makers, but we didn't record the journal entry. Instead, Daglin continued to make the journal entries for depreciation expense in years 2 and 3. We need to make the necessary correcting entry if the year 3 books are still open and if the year 3 books are closed. Step number 1 is deciding, do we need to make an entry? And the answer is, you bet. This is a non-counterbalancing error. There is no way that this will fix itself. Over time, this asset is not going to simply disappear from our books as if it had been sold if we leave it alone. So because it's non-counterbalancing, whether the books are open or closed, I have to do a journal entry to get this fixed. Yes, a journal entry. We need to jump right into steps 2 and 3 and look at what we did versus what we should have done. So first things first, we need to pull out some key numbers here that we can use in our calculations. On January 1 of year 2, we had historical cost of $25,000. We have accumulated depreciation of $15,000 that should have been eliminated, and we had cash of $9,000 that came in. In addition, it says we reported $3,000 of depreciation in year 2 and year 3. So we have got both depreciation expense and accumulated depreciation that has continued to build over these last 2 years. Now that we have those key numbers, let's take a look at our journal entries, and we'll take a look at what they did on this side. And let's see, we've got year 2 and year 3. In year 2, what they did is they recorded depreciation expense and accumulated depreciation for $3,000. Then in year 3, they did the same thing. What they should have done was sold this off. So this is should have. Year 2, year 3. We got cash, we said, of $9,000. We have accumulated depreciation as of January 1, year 2, we were told $15,000. The historical cost of the machine or equipment was $25,000. And to balance that out, we would have a loss on sale of $1,000. And in year 3, this is sold, so we would have done nothing. So now we've got step 1 done. We know we need a journal entry. Step 2, this is what we did. Step 3, here's what we should have done. Now step 4, what, if any, accounts are okay and what accounts need to be changed. And if we look at what we did versus what we should have done, there is no synergy here at all. We have blown this so badly that everything needs to be fixed. So as I get ready to make a journal entry, I've got to fix it all. So let's start if year 3 books are open. And again, there's simply no synergy here. There's nothing I can cross off. There's nothing right in what we did. Everything is wrong or backwards. So let's see here. First off, I need to record cash coming in of 9,000. I know that. Second, I know I can get rid of that machine. So let's put that in here. And the machine right here, $25,000. Let's see, what else do I know? Well, I know that I've got to debit away accumulated depreciation, but I'm not sure how much. Let's go back and take a look. It was at $15,000. That's why up here I showed a debit to $15,000 because I was going to get rid of it. So at the beginning of year 2, it was worth $15,000. Since then, I've now added $3,000 from up here and $3,000 from down here. So my current accumulated depreciation is $21,000. I need to fix that then. So I've got to get rid of accumulated depreciation of $21,000 because of the entries that I've made. In addition, right down here, I've got a depreciation expense in year 3 that should be 0. So I've got to get rid of that depreciation expense. $3,000. Now let's take a look. I've taken care of the cash. I've taken care of the accumulated depreciation, all of it. I've taken care of the machine, and I've taken care of this depreciation expense. What I need now is something that will fix this difference. So let's take a look at our retained earnings account, because the depreciation expense did get closed into retained earnings, and the loss should have been closed into retained earnings. So since it's all year 2 stuff, the loss and the expense are gone, and it all should be in retained earnings. So I did put 3,000 in there. I should have had 1,000. So if I'm going to get from what I did to what I should have done, I need a $2,000 credit to retained earnings. Again, because these are closed accounts, depreciation or the loss, I can't change the expense or the loss account. I have to go to retained earnings because of closing entries. So let's see, retained earnings, 2,000. And if I've done that right, at this point, everything that was wrong should have been fixed. So if we look at that, let's see, 21 plus 9 is 30,000, 25 plus 3 plus 2, that's also 30,000. I balance, and that's my correcting entry. For sale of machine. Not recorded. In year 2. Wow, that's a mouthful. So if year 3 is open, that's what we do with our journal entry. Now let's take a look at what happens if year 3 is closed. So I'm in year 4 when I find this mistake. Let's think about this. The cash would still need to be taken care of. The accumulated depreciation still needs to be taken care of. And we aren't told that we found it in year 4 and they did more depreciation expense. They just recorded this extra depreciation expense in years 2 and 3. So I'm good with that same $21,000 number. I still need to get rid of the machine. So what I need to look at is what happens with these two numbers, retained earnings and depreciation expense. Well, once year 3 is closed, depreciation expense would have been closed into retained earnings. So let's take a look at our T account again for retained earnings. I should have a loss of $1,000. I know that because that's the one change that would have affected retained earnings here in the should have done column. If year 3 is closed, then this $3,000 up here would have been closed to retained earnings. And I also would have closed year 3 to retained earnings. So both of these will have gone to retained earnings. So now I've got a debit to retained earnings of $6,000. So again, I need to move from where I'm at to where I want to be. That's a $5,000 credit. So retained earnings, $5,000. And if I look at that again, 9 plus 21 is 30, 5 plus 25 is 30. The description would look exactly the same. and I'm good to go. Now that we've got the journal entries done, both for the interest and for the depreciation, I've finished all of my steps for correcting errors except fixing the statement of retained earnings. And we'll work on that when we come back. We'll see you then.